Coming up, I'm looking forward to this in just a moment. James Thorne, Chief Strategist, Senior Portfolio Manager, Caldwell Investment Management. But first, this week's quote of the week. I love this when British author Martin Amis said, "This is a big job because being inoffensive, being and being offended are now the twin addictions of the culture." Well, my quote goes to Dostoevsky, as that's the warm-up act. You know, the man who wrote The Brothers Karamazov, The Idiot. He says this: "The man who lies to himself can be more easily offended than anyone." You know, it's very pleasant to take offense, isn't it? A man may know that nobody has insulted him, but that he has invented the insult for himself, has lied and exaggerated it to be picturesque, has caught on a word and made a mountain out of a molehill. He knows that himself, yet he will be the first to take offense and will revel in his resentment until he feels great pleasure in it, and then so pass into genuine vindictiveness. I think that does describe our culture right now. The culture of complaint, the culture of victimhood. It's quite something. Time now to go to James Thorne. He's the Chief Strategist, Senior Portfolio Manager, Caldwell Investment Management. James, thanks so much for taking the time with us.
Thanks, Michael. How are you today?
I'm great. I'm wondering how you're doing with this kind of an investment environment.
I'm doing great. This is what we get paid for.
Yeah, great. And the fund does very well. I know that. But, seriously, is it more difficult when geopolitical events can jump up out of nowhere, like the Turkish coup, or maybe something like the Italian banking crisis that I think's got another few legs to go? Or maybe it's a central bank announcement that wasn't anticipated, or at least that some of the market hasn't anticipated because they usually take a big reaction to it. How does that change your approach, if any, or at least how do you factor in those kind of events into your investment strategy?
Well, those are big questions, and let me just step back and so when the way I look at the world, or the way we look at the world, is let's throw a couple of assumptions so you get on the table, so you get where I'm coming from. First off, the world, our economy, doesn't export to another planet, right? So everything's got to balance. Deficits and surpluses have to balance. And if somebody's going to grow, they're going to take that growth away from some other economy or some other firm. And there are two economies that are manufacturing too much and consuming too little. That's China and Germany. So that's the first thing. Number two, our institutions, whether it's the Federal Reserve, whether it's the EU, whether it's NATO, these institutions that were developed after or around World War II are no longer relevant in 2016, and we have to get comfortable with that. I would even lay on top of that the countries in Eurasia that were developed or picked or developed by the French and the English after World War II, around 1914, or that period, they're no longer relevant. So we're in a period of time of huge flux. And Mike, if you accept that, then you understand that, you know what happened with Turkey, I can't foretell the future, but am I surprised? No. Turkey is has to become a regional power, just like the Ottoman Empire did 500 years ago. Europe and Brexit, everybody now knows it's not about England. It's about the fact that the only country that benefits from the EU is Germany. 50% of their exports, 50% of their GDP is exports, and the only one that's benefited from this experiment has been the Germans. And nobody wants to join the EU. Everybody wants to get out. And Michael, in our lifetime, we are going to have to deal with this because there is no decision-making mechanism in the EU for them to determine anything, whether it's the Italian banks, whether it's the immigration problem, you name it, it is dysfunctional. So if the central banks are fighting the wrong battle, inflation, deflation is the problem, demographics, globalization, and technology are deflationary, and yet the policies that these guys and the restriction that these central banks have been straddled with were developed in the 1970s. So if you understand that this is the case as a global macro strategist, then you understand this, and then it's like sitting there in February in the Midwest, knowing that it's going to be cold, and you pick your spots. So as Warren Buffett would say, when people get greedy, you get fearful, and when people get fearful, you get greedy, and you just continue to maintain your intellectual flexibility and look for opportunities to make money.
It's interesting. I was thinking when you're saying about the EU, it might be a public service if you emailed every one of our political commentariat with maybe one or two exceptions only. And I get a lot of chance to read. I do make time to read right across the country. And it was amazing to me. On this show, we correctly predicted that the Leave side would win for ages. Never got off that. But for the very reasons you're talking about, I said, no, the EU's the problem here. And it's just funny how our commentariat's so entrenched in the establishment way of thinking in a world, as you've just pointed out, that is changing so dramatically. I'm just finding it astounding. And that's the key component for investors is we're in this huge flux, as you say, and then it's how to kind of orient our investments to account for that.
Michael, this is no different than 1905 after Germany reunified in 1871. There was a period of globalization. Germany rose up, became an economic power without any countries. Think about the English Empire. They didn't have any of that, and there was concern. And we had 30 years of war where 100 million people in Europe were killed. And yet, as we were walking into this period, there were really smart, sophisticated people saying there is no way the French, the Germans, and the Russians are going to go to war because it's going to cost them too much money. Well, boy, oh boy, weren't they wrong. Boy, oh boy, weren't they wrong. But that's as long as you accept that and recognize the fact that, you know what, German has the weak hand now. And just like in 1914 and 1915, they were asking the question, what is Germany going to do? It's the same question. What's Merkel going to do? I have no clue. I think the difference is, just like using a poker analogy, is if you don't know who the patsy at the table is, then you're the patsy, right? Everybody now knows that Merkel has the weak hand. What are the Germans going to do? Are they going to help the Italians bail out? Or, what are they going to do? And here's the point where I think you're very profound in thinking this way. We don't know. And the rise of the nation state right now, think about what's happening with Trump in the United States. Think about the far right, that's, the five-star movement in Italy. Think about Le Pen in France. Think about just what happened in the UK. This is a huge groundswell. And it's generational. And we have to deal with this as investors. But as long as you understand that, you can pick your spots and you can make money.
Do you have any idea why, speaking of that trend, let's move on to the deflationary trend, which I couldn't agree more with. How have they missed that boat? I mean, that's the problem for Canada, throughout the emerging markets that rely on commodities as the underpinning for their economy. I'm just surprised how it's so tough for people in power, including our central banks, to understand that's the environment we're facing right now.
It's the $64,000 question, because next week we're going to have the Federal Reserve talking, and listen, the last thing the global economy needs right now is the United States to raise rates. What we need is the U.S. dollar to go down, commodity prices to go up, and allow the healing that needs to take place in the emerging markets and to generate economic growth. But I've worked in a large institution before, and I think what happens is, in a large institution, what is common sense gets marred down in the politicking that happens. And make no mistake, the Federal Reserve is a highly, highly political institution. And I would suggest to you the people like Yellen and Fisher come from a period of time where inflation was the risk. Inflation was the big risk. So I'm really concerned that they make the mistake. I'm really concerned that the Federal Reserve is fighting the wrong battle. And if they do, then we have to change our investment process, not a process, but our focus really, really quickly. Because if the Federal Reserve starts raising rates, this is not going to end well.
I'm talking with James Thorne. He's the chief strategist and senior portfolio manager for Caldwell Investment Management. I'll come back and I'll ask him what kinds of things you should be looking at then in this huge environment full of flux. But we just got more reports this week that the Federal Reserve, the probability is high that they will raise rates. Well, what does that mean to all of us? We'll do that with James Thorne when we come back on the Money Talks Network. Coming up, I got a shocking stat for you, one that I hope you stay with us because it will shock you. You're sitting down and it's not positive. I also have a goofy award. I've been sitting on this one for a couple of weeks. I just dying to get it in. So I said, this is the week. I'll put it in as my goofy award. Plus, live from the trading desk, Victor Adair. We've also got Ozzie. But I'm talking right now to James Thorne. He's the chief strategist, senior portfolio manager for Caldwell Investment Management. You can get more information on their funds at caldwellinvestment.ca, but three of them I follow is the Caldwell Balance Fund, the Caldwell Canadian Value Momentum Fund, and the Caldwell U.S. Dividend Advantage Fund. As you know, we've talked about that one simply, well, for a couple of reasons. One is it's well managed, but the other thing is that it's in the U.S., and you know we're bulls on U.S. dollar here on Money Talks and have been since Canadian was $1.03, so it's not Johnny-come-lately as some are. But James is the chief strategist, senior portfolio manager. James, before the break, you're doing a wonderful job sort of explaining this kind of environment that we're investing in. And I started right away with, you know, what should we do when central banks kind of come out with policy that seems to change a lot of things? And the one you just alluded to is, what if the U.S. does raise rates? As again, this past week I've been reading that probability is high.
Well, we have this thing called a negative feedback loop. And I think what happens if they start raising rates, given what's going on in the world right now, I would suggest to myself and to you and to your listeners to get defensive, because this is not going to end pretty. This will not end pretty. We will get a credit crisis. We will get a high yield crisis in the United States. We will get an emerging market sovereign debt crisis. This will unravel really, really, really quickly. And I am hoping, and you know, Michael, hope is short, but I am hoping that the Federal Reserve just chills out and goes away. There is no reason right now for them to raise rates. I would argue, though, Michael, there's more reasons for the Bank of Canada to raise rates than there is for the Federal Reserve, in the sense that we've got two big property bubbles going on in Vancouver and Toronto right now. And so what I'm hoping for is that the Federal Reserve lets cooler heads prevail. And I think one of the things your listeners should notice is that what's the subtle things that's happening now is with all this liquidity that's been pumped into the system, you know, the volatility in the stock market is about historic, but where the real wild rides are in the currency markets and in the fixed income markets. Michael, on Friday, we had a great retail sales number in Canada, a historic number, and yet the Canadian dollar dropped. Why? It was because all these currency traders that are looking off of these charts that are chicken bones and making this view that the Federal Reserve is going to raise rates, they're positioning. So if the Federal Reserve doesn't raise rates next week, and what we're saying is, and how we've positioned, is that we don't think the Federal Reserve is going to raise rates until after the election. But if they do, then I think you've seen the run. If they don't, and they give a message that's saying chill out, then I would expect to see a significant sell-off in the U.S. dollar, because everybody is positioned for the Federal Reserve to get hawkish. Given what we talked about in the last segment, the best thing that these central bankers could do is go away. Just go away, be quiet, and let the market reach its level. The other thing it needs to do is it really needs to recognize the fact that in 2016, we are on the cusp of a debt deflationary spiral, and if they screw this up, this could get really bad, really ugly. So, Michael, if they raise rates, we have 1937 on the table again. Everybody knows it. Everybody's worried about it. Yellen knows this. Fisher knows this. But will they have the will and will they have the courage to say, no, we're not going to raise rates? And if that's the case, then it's risk on. Commodities will rally. Money will flow to Canada. The Canadian dollar will appreciate in value, and we'll get a nice risk rally going on into the federal election in the United States. That's what we're hoping for. But yet, at the same point in time, you always have to have your hand on the door to make sure that you're willing to exit these markets if these policymakers make some really stupid mistake because of some political agenda.
Well, it's interesting. You said central banks, Federal Reserve should just go away. I'm hoping they bring the politicians with them. But I think they'll come out this coming week and say we're not raising, but we're going to soon. That's my guess is what they'll say. And I'm not sure where that leaves the market then.
Well, the trade-weighted dollar index, or the DXY, which is what everybody looks at, is at 97. So the market, the U.S. dollar started to appreciate in value when Bernanke started the taper tantrum, and they started to jawbone that they were going to, or communicate that they were going to raise rates. And from that point in time, that dollar index, that trade-weighted dollar index, went from a number of 80 to almost 100. We're at 97 right now. The interesting thing, Michael, is when that was happening, people were assuming that when the Fed raised rates, they were going to raise rates to the historical normal average, which was going to be about 4%. I think that's off the table. So where I'm a little bit non-conventional is the fact that even if they raise rates, they can't raise rates as much as historically they think they can. And on the other side, when you read, first off, the Bank of Canada and these guys are always behind the curve, right? I mean, last year the Bank of Canada was talking about oil at $75 and $80 when oil was crashing, and they were saying everything was fine. Now they're pricing in, $30 to $40 oil, and the market will correct. And we've got two property bubbles going on in this country right now. And I'm telling you, they are going to have to react to this. I was in Vancouver last week, and I live in Toronto. I was 15 years in Washington, D.C. This is not going to end well unless these guys, the Bank of Canada, starts doing something substantial. Because in Washington, D.C., where I lived, when housing prices start to go down, we see who's wearing clothes, or we see who's over-levered, and we see what really the prices are when all the inventory hits the market at the same time. So I think you may be right, 50-50. I am hoping they say nothing that they're going to raise rates, because if they do, and this is the whole problem, if they talk about this and they talk about raising rates, then the market will discount this ahead of time and we will get a significant correction. And I hope the Federal Reserve has learned their lessons to be quiet, to chill out, and to go away. But if they communicate that they're going to raise rates in September, then risk off.
Great stuff with James Thorne, Chief Strategist, Senior Portfolio Manager of Caldwell Investment Management. You can find him at caldwellinvestment.ca, caldwellinvestment.ca. James, thanks so much for finding the time. Terrific stuff, very important for people to hear. Hope we can visit again in the near future.
Thanks a lot, Michael. Have a great day, everybody.
Good stuff. Come back with a shocking stat. Coming up, I've got Ozzie with us. There's been a new crackdown by the Canada Revenue Agency. More bureaucrats, but what are they targeting? Well, a leaked documents lets us know. Ozzie, after the break here. I never know which of my comments are going to sort of solicit the most response. Well, this one brought a massive response, some positive, some negative, and it's always a wow for me, especially from people who really haven't done much research, but my goodness, they're strong in their opinions when they respond. Let me play the comment first.
I wonder if anti-free trade, pro-tariff advocates who push higher prices for Canadian consumers, like the Council of Canadians, public sector unions like the BCTF, are a wee bit uncomfortable to find themselves on the same side of the issue as Donald Trump, who's repeatedly stated he's anti-free trade, including talking about reassessing NAFTA. I wonder if they're proud of the success of their misleading propaganda, much like Mr. Trump's approach, come to think of it. According to a recent Angus Reid poll, only 1 in 4 Canadians thinks the North American Free Trade Agreement is good for the economy. 75% Canadians think NAFTA is bad, despite the fact that, according to a new BMO Capital Markets Canada study, total trade within NAFTA went up from $239 billion in 1994 to $567 billion in 2015. At the same time, unemployment went from 10.4% to 6.9%. The Council of Canadians says NAFTA costs us 500,000 jobs. Well, you got to compare that to the U.S.-based Council on Foreign Relations, who said net we've gained 4.7 million jobs since NAFTA came into effect. The majority of Canadians either don't understand or don't want the lower prices that come with removing tariffs. Just to be clear, it's tariffs that prevent you from buying less expensive milk, cheese, other products that many Canadians actually cross the border to get. If Donald Trump becomes president and follows through on his talk of renegotiating NAFTA while putting sky-high tariffs on China's exports, we're going to get a first-hand look at the negative impact on our economy and job growth. As H.L. Mencken famously said, be careful what you wish for. You just might get it, good and hard.
It's very interesting there. You know, this is one of the worst ideas that Mr. Trump has presented, is his anti-trade, anti-free trade kind of agreement, and including NAFTA that he says he will look at and may renegotiate. This is going to be terrible news for the Canadian economy. And the fact that we have that many Canadians who don't understand that is a testimony to how poorly our education system educates anybody in terms of economics. I mean, come on. We got 34 million people in this country, and we're saying no to the opportunity to sell to 325 million in the U.S. No, it makes no sense whatsoever. And it's been a huge boon to so many industries. Go ask somebody in the lumber industry if they're worried about the free trade agreement that's just coming up with vis-a-vis lumber, our trade agreement with the U.S. on that. No, it'll be disastrous, but I'll leave that for now. I'll get other chance to talk about it, but I am blown away. Time now for this week's shocking stat. I'm just going to give you some quick numbers here. The death count for terrorism in the West is 658. This is since the beginning of 2015. 658. 47 different terrorist attacks. Now I want to compare that with what's gone on in the Middle East, Africa, and Asia. 28,031, and now we have to tack on 61 more in Afghanistan attack yesterday. So that's 28,092 now in the Middle East, Africa, and Asia. 2,064 different attacks. It's incredible. The Middle East and Northern Africa account for over 2/3 of terrorism attacks since January 2015. They literally occur on a daily basis. Their average is claiming at least a dozen lives, 12 lives. And it's interesting, I was commenting to somebody in the media after the Nice attack. I said it's interesting, the media virtually ignored about a dozen other attacks in the preceding month. But we get way more coverage for Nice, and we should have a look at why that is. I'll give you one more shocking stat on that. Defense spokesman said as of January 31st, the total cost to U.S. taxpayers of anti-ISIS operations, now they began in August 2014, so we're just coming up to the 2-year anniversary. The total cost, $6.2 billion. The average, they're spending $11.5 million per day, and that's about 543 days or something like that. Incredible. I'll take a break. I'll come back. There's been a new CRA crackdown, more bureaucrats, but what are they targeting? A leaked document's going to let us know. Ozzie here after the break on the Money Talks Network. If you didn't get a chance to listen to James Thorne, or you want to re-listen, because I think there's a lot of stuff there, I'd encourage you to share it with people. I think that's a very important context that he's painting for us and what it's going to be like in the investment markets. I thought he did a great job great job with us. We'll just go to moneytalks.net. Moneytalks.net. While you're there, you can also sign up for our Facebook, which is Michael Campbell's Money Talks, or our tweets, which is Money Talks Tweets. I'd really encourage you to do it. And while you're on Money Talks, you can read some of the top articles of the week. I found this really fascinating. It was called "These Are Danger Signals, and They're Flashing Now," from last year's Templeton Prize winner, by the way. Really good summation of why the West is in such decline. The terrifying $2 quadrillion monster, now totally out of control. Really good article on that. So you can do that anytime. Go to moneytalks.net. Listen to any of the business comments. You can sign on to Facebook and Twitter with that. Time now to go to the Ozzie Jurek side of things, because I'll tell you, I got some questions for him today. You know, a new leaked document coming out of the Canada Revenue Agency. All I know is it meant there's going to be more bureaucrats, more people looking at stuff. Ozzie, tell me what they're looking at.
Well, it's kind of interesting. It was a leaked document of all things to the South China Morning Post. That's where we got it from. But anyways, the idea was, it sort of was entitled Real Estate Webinar, the specific region, and there was sort of been a reaction to the foreign investment. So you'd think that the document was for foreign investors, but actually no. CRA called for more tax enforcement, but it will likely be the local Canadians, you and me, Mike, not the mysterious foreign investors who face more scrutiny.
The thing that grabbed me, though, Ozzie, is that they're hiring a lot of new personnel.
Yeah, 50 more auditors, 20 GST auditors, and 15 other staff will be deployed to BC, all focused on real estate taxation.
So they're not going after the foreigner. They're obviously then going after us.
Yeah, they tried, I guess. Last year in British Columbia, the document showed that only one successful audit of worldwide income was conducted in BC over the past year, and they collected the princely amount of $26,000. That, of course, warrants 50 more auditors.
Yeah. What are they after, though? I mean, what kind of behavior are they targeting?
Well, of course, you know, there is probably a good reason for it. Look, Mike, I personally, I'm not joking either. In my courses, I say, look, I want to pay $1 million in taxes. I'm not against taxes. I mean, I don't want to pay more than I owe, but I think I like the thing that taxes provides for me. But what CRA will be after is unreported worldwide income, property flipping. They're going to take a good hard look at it, underreporting of capital gains, and underreporting of goods and service tax. So, for instance, quite often people assign a contract, and I think since there was never a registration of the land, there's no taxes. But it's capital gain taxes. Anytime you make capital gain, you got to pay for it. That's what they look at.
You know, there's just so much to this. I still think government's going to be the one to put an end to the price movement that we've seen, at least in the couple of neighborhoods that James Caldwell was talking about, or cities, you know, Vancouver and Toronto, so well chronicled there. I just worry that there's just too much paperwork, Ozzie.
Well, it'll be huge, but and there might be some reason. Maybe there's some builders who flip property frequently and don't report the income as business income and all those kind of details. But yeah, there'll be a lot more paperwork for everybody else, and it will not really affect the foreign investor. Actually, the document itself says that CRA compliance work will increase visibility and lead to more tax compliance, but will not address the major concern about affordability of real estate.
No, and everything I've heard so far when they talk about policies like the vacant property thing that we heard last week, I mean, none of that's got anything to do with. Yeah, it absolutely is. Hey, Ozzie, let's finish on a very positive, happy-go-lucky note. You found us an inexpensive rentable condo in Sydney on the island,
actually,
Vancouver.
It's a one-bedroom, one-bathroom, 660 square feet. It was built in 2009, so not too old. It's close to Rest Haven Waterfront Park. And it's only $265 a month starter fee. Now, that's the least expensive in Sydney. Now, think about the one we talked about last week, the $63,000 same square footage, one bedroom, one bathroom in Kimberley with a view, fully furnished and a fireplace. And you can still see that throughout the province, we still have some smoking deals out there.
Let me just grab one more. Again, Sydney is just outside of Victoria, but you got one for us in Victoria.
Yeah, actually, the cheapest home in Oak Bay is now on at $590,000, and I tell you, the next cheapest is $250,000 more at $869,000. And this is, of course, a golden oldie, but still, hey, it's a good price. It's some tender loving care that just might make you some money.
1911 it was built. Ozzie, thanks. Great as always. We look forward to more good deals. Now, just remember that Ozzie just brought to us the cheapest house. Oak Bay is a wonderful neighborhood if you're not from the Victoria region. The cheapest house in Oak Bay. And you can just go a little bit further out, go to Sydney, and which is a beautiful community, I might add, at $284,000 for a rental property. Ozzie, go out, enjoy the weekend. Please go boating.
Thanks, Mike. And you have.
I said that on behalf of the population who golfs. Thank you.
You know, Mike, last week I broke 90, so I had a few beers to celebrate. But I was so excited I forgot to play the back nine.
Yeah, there you go. I suspected that, by the way. Great stuff. I've got Ozzie Jurock. Go to Jurock, Jurock.com. I'll take a break coming up. I want to know what Victor Adair's been up to in the market. He'll join me live from the trading desk. Plus, I got a goofy I've been leaving on the shelf for a couple of weeks. Time to bring it out for your approval. All of that on the Money Talks Network. Coming up, I got a Goofy Award for an event that happened on Wednesday. Again, it had me shaking my head. But right now, I got to go live to the trading desk. I got Victor Adair on with me. Great conversation with James Thorne, who you know. And it just brings me, I got to come right to you, Victor, and say, hey, what have you been up to in the markets?
Well, for my short-term trading accounts, Mike, and short-term for me means like a few days to a few months. My current positions are I'm long the U.S. dollar index. I'm long the U.S. dollar against Canada. I'm long the U.S. dollar against the yen. And I'm long the U.S. dollar against the Australian dollar. That's on the currency side. In commodities, I am short of WTI crude oil. I'm short of gold. In interest rates, I'm short of bonds. And in the stock market, just here at the end of this week, I started to write some calls on the American stock market, thinking maybe it's a little overdone. A big part of the way I trade, by the way, is that I see dramatic swings in the sentiment in the market as providing opportunities to buy markets that are oversold, to sell markets that are overbought. Just like James was saying a few minutes ago, you get these emotional swings in the market, and that gives you opportunities to sort of go the opposite way of what people who are reacting to the emotional swings are doing.
Well, we've been talking on the show, and I'm very proud we have. You have done it. I've done it, talking about one of the key factors that you just alluded to in your own trading account. You're playing the U.S. dollar to go up against Canada, against the yen, against Aussie. Really, I think it plays a part in the commodity side, too. And that's still the key thing you're obviously looking at. Yeah, I mean,
I have some core market opinions, I guess, and one of them is I think the U.S. dollar is in a bull market. And when I'm looking to do a trade, if the trade lines up with that, then I'm likely to be a little more aggressive with it than if I'm going against that. And my main trading idea going ahead, I think, will be to look to different ways to ride the U.S. dollar bull market. When you look at the Canadian dollar, okay, we always look at that. We live here. Let me say this. Canada is particularly vulnerable to weak oil prices, okay? But what is really the story is it's the U.S. dollar going up, not Canada going down.
Let me come to a couple of quick ones here, a little further explanation. I got to ask you about gold because got a lot of people think that's a new bull market, but they may be talking longer term. We certainly have, you've been rewarded, for your short gold position of a couple of weeks ago with a pretty good decline. But you're still in the trade, I guess is what I'm saying.
Yeah, I mean, I think for the past couple of months I've been warning, let's say that, about what I call a positioning risk in gold. Now, gold had a high back in 2011. It fell about 45% into the end of last year and started to go higher. People love to pick the bottom of a market that's taken a big beating, particularly, if they think there's something to the upside. We saw speculators stampede into the gold futures market and into the gold ETF market, and certainly we've had a very dramatic turnaround in gold stocks. I respected that. I was long for part of that. But what I saw was that toward particularly here post-Brexit, when we had gold rally $100 on the Brexit day, fell off a bit and then rallied some more, but then it seemed to peter out, and I thought at that point I was getting paid huge to write call options on gold, and I said, I am going to short enthusiasm. I did. The call options evaporated in 2 weeks. I took the position off. I've remained short of gold. And, I manage risk on these things for sure. But if it remains short of gold, I think there's a risk we could have a washout because the boat's so heavily weighted on one side with bullish speculators. That does not mean I think gold is going to zero. I think gold could go a lot higher later, but for the time horizon I'm trading in, that's how I'm positioned.
My man Victor Adair, live from the trading desk on fire. Great stuff. And Victor, I just want to reiterate that on Money Talks, you clearly said that when the Canadian dollar got just above 80 cents, I was early on that. I said 78. You said, no, wait a minute, it's going to go. It goes to 80. You said that looks like it could be the high for the year. So I'm giving you a pat in the back for that one. Victor Adair, live from the trading desk.
Michael,
Thanks,
that
Vic.
was May the 3rd. That was May the 3rd, and that was the same day the U.S. dollar made its low for the year.
Yeah, I know. I thought it was just a great call. Go out and have a great weekend.
Thanks, Mike.
My thanks to Victor and all of my guests. Just a reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty fee-based investment, which means you get paid first. You're first in line for income. There's no fees attached, and you can find more information because it's in the tech field at soleraclub.com. Time now for this week's Goofy Award. Oh, this is a beauty. One of my big complaints about the environmental movement has been their leadership, especially when you talk about celebrities not walking the walk. But many politicians are in that boat too. For example, President Obama, $70 million in personal travel fees, could have cut down on that a little bit, maybe $1 million worth. Well, this one goes to Leonardo DiCaprio, probably the foremost spokesperson for global warming from the Hollywood A-list. Okay, you got to listen to this one. He just held a gala on Wednesday, and he couldn't hold it. It's part of his gala to fund climate and biodiversity, but he couldn't hold it in the U.S. No, he held it in the French resort of Saint-Tropez. Think about how elitist that is. It was incredible. Celebrities reportedly were Kate Husband, Charlize Theron, Kate Blanchett, Penelope Cruz, Robert De Niro, Arnold Schwarzenegger, Kevin Spacey, a ton of international rock and pop stars. Why? Because they all want to talk the talk. I mean, it's an expensive event to go to, but here's the incredible thing. If just one of those guests, 500, chose to fly personally, it's a 12,000-mile round trip, by the way, from L.A. to Saint-Tropez, you know what the environmental impact would be? 86 tons of carbon dioxide in the of green grass. This guy's trying to do my personal carbon footprint for my lifetime in one gala event. In fact, I'm sure he's done that. If you took the regular commercial flight, keep in mind it's still 7 tons each. So it's incredible. And I must say, I want to pat some environmental leaders on the back who've been very critical of this, and well deserved, but it's one of the central problems for people taking the environmentalist movement seriously, especially out of the mouths of celebrities. They do not walk the walk. Quit apologizing for them. If you're truly interested in CO2 emissions and global warming, you would denigrate this kind of behavior. That's all the time I have today. Don't send me the emails, the hate mails for that one. Go to moneytalks.net. Have a great weekend.